Markets change. The unknown unknowns are what move markets, while the known unknowns are already priced in. Declines happen, but history shows they've all been temporary. The advance is what's permanent. I'm Mike Bishop.
And I'm Michael Bishop.
As fiduciaries, with decades of combined experience, we've helped investors navigate the noise with a disciplined, long-term plan. The key to success is acting on a strategy, not reacting to headlines. Welcome to the Fiduciary's Edge, where we break down the risks, opportunities, and realities of managing wealth the right way. Let's dive in. Hello, welcome back. I'm Mike Bishop.
And I'm Michael Bishop.
This is episode 5 of the Fiduciary's Edge podcast. And this year we have gone video. So we've stepped up our production and we hope you enjoy this. Episode 5, we're calling The Building Blocks of Estate Planning. And we have a barred attorney online here with us. Also, I'll be peppering Michael with questions, things that we hear often in client meetings, trying to give you practical advice to help you understand more of maybe what's needed to see your own attorney as far as preparing for your own estate plan. So let's get started.
Great.
Michael, thanks for joining us for this.
Well, happy to be here.
Good. I think from the beginning, there's so much mystery about estate planning, from a simple will up to complex generation skipping trust and things we've dealt with recently, GRATs and more complex estate planning tools. And most people have a surface knowledge over what I need versus they hear, like any discipline, they'll hear something from someone else and think, oh, I should have that, not knowing if it applies or not. But I think one of the things that you and I agree on with this is almost like a pyramid. As your wealth grows, your estate planning needs become more complex. So
Absolutely.
Not everyone needs complex trust and generation skipping trust and detailed financial estate plans. And I'll let you answer this because I'm not an attorney, but I think you would probably say everyone should have a will and beneficiary designations. But it gets more complex as the wealth goes up, and it can be much more simpler as the wealth is maybe not at higher levels.
Yeah.
Is that a good way to say that?
Yeah, I would agree with that. I think before we jump into the pool, really, 2 important thoughts that I have as general advice for everyone is, 1, I am an attorney. I am not your attorney. I'm not giving advice. The normal disclaimer that we give with every episode, but just we want to provide things that help you think through, where am I at in my estate planning? Because your estate planning starts truly as soon as you start earning income, really. So that's young people too are in the mode of estate planning. So where am I at? What do I need to get to my goals? And second, as a reminder to stay in your own lane here, especially with estate planning. There's a lot of comparisons. We hear it with clients trying to keeping up with the Joneses type attitudes, where they'll say, oh, I heard my neighbor who, let's just say did the same type of thing I did, has the same amount of money that I do, and they have this complicated trust scheme for tax savings and putting the house in this and titling this to the kids and stuff like that. And I don't have any of that, so I feel like I should just do that.
Yeah.
And so that's the second piece of advice here, is really remember to stay in your own lane, build the estate plan that works for your estate. Even if in that example you have 2 people who worked the same job over the course of the same amount of time, their estate needs at the end of life could be dramatically different. And that is going to result in a different structure of an estate plan. And how assets are ultimately disposed of too. Because life happens. You have kids, you want to benefit more people than just immediate family. You have charitable benefits that you want to make. You have health concerns. You have health concerns in the family that you want to take account of. It is very variable how to move through an effective estate plan. But the bottom line is your estate plan is going to look different than your neighbor's estate plan because you're different people and you have different lives and different goals. So the biggest takeaway I'd like people to walk away from this episode with is talk to your attorney about your estate plan, because there's no such thing as a one-size-fits-all estate plan. To your first point you made, I would absolutely recommend that everyone have a will. And when you think about it on a very basic level, once you are over the age of 18, once you are in the age of majority, your parents don't have control over you anymore. They don't have
What?
I hate to break it to you this way, brother, but they don't have control over your assets. They obviously are a great source of guidance and can help you think through issues, but you're an emancipated adult, and so you need to make sure that, God forbid, if anything were to happen to you, that your affairs are in order. And so I do recommend to my friends, get a simple will done early on. I think the most common point to get an estate plan, to really start thinking about that for most people, which is fine, is once they have kids. Especially once you've had your first child, whether you are married or not married, once you've brought that first kid into the world, you absolutely got to start planning for, if I'm not here to take care of this kid before it's 18, something needs to be prepared for. So that's as a baseline.
Okay.
Whereas when should you have an estate plan? As soon as you start making money, absolutely as soon as you have kids.
Okay, so that's the basis.
That's the basis.
Well, let's start with probably the most common, I'm going to again say mystery or question that we get, I hear often, is a lot of people have a faint understanding of, don't I want to give my money away to avoid estate tax?
Yeah.
And then I try to explain, well, there's inheritance tax, federal estate tax, and most people eyes glaze over at that point and don't understand what that means, the limits of gifting. But there's this sense out there that when you die, the government's going to tax your estate. Yep. And can you talk about that?
Yeah, happy to, because it is very complicated and everyone has an opinion about it, but not a lot of people know what it is.
Right.
So speaking from my experience as working as a Pennsylvania attorney, barred in Pennsylvania, we're sitting here in Ohio filming this episode, so I'm not intimately familiar with anything outside of Pennsylvania. But generally, let's start basic here. When you die, your assets go into your estate. The estate is an entity. Like a corporation is an entity, your estate becomes an entity too, to handle the disposition of your assets. So everything that you owned in your name, bank accounts, real estate, investment accounts, vehicles, all knickknacks, clothing, everything goes into your estate to be settled by your personal representative. So that's someone that you can appoint in your will. You might have heard the words executor, executrix, administrator, administratrix, personal representative. Those are all synonymous for who is the person or persons responsible for getting the things in my estate out of my estate after my death.
Okay.
They're kind of the point man for that responsibility. Getting things out of your estate follows the legal process called probate. So if you've ever heard, I have this as a quote-unquote probate asset, or this is not subject to probate, or that's what that is. So things that are in your estate at death, to get them out of your estate, which means to get them to your beneficiaries that you've designated in your will, that needs to go through the probate process. That's the legal process that empowers that personal representative to give things to people. Because you know that you're dead. You can't start giving your assets out. You need someone to do it for you. So this is just the legal process that blesses that whole transaction. The short of it is everything is included in your probate estate except things that provide for beneficiary designations. So we see this very commonly is investment accounts, IRAs, 401k accounts, allow for you to make a beneficiary designation. And most common, that's like, well, I'm going to name my wife as primary beneficiary designee, and then my 2 kids as 50% contingent. What that means is when you die, again, everything pours into your estate, except that 401k account. Because you made that beneficiary designation, it will go automatically to your designated beneficiary without needing to be blessed by the court, handled by the personal representative. It just goes immediately into that person's hands. And that whole process, we do this with clients who pass away and their kids step into the role. That happens quick. That transfer, that from possession of the estate to possession of the beneficiary, can be a handful of days, maybe a couple weeks once we get the death certificate and everything. So probate is a slower process to get rid of your assets at death. Making beneficiary designations is much faster to get those assets, that the liquid assets like investments, out of the hands of the decedent into who they want to benefit. And so that's really what probate is. And so then there's a lot of discussion around, well, don't I want to avoid probate? What are the benefits of avoiding probate?
Most people think that's something to avoid at all costs. Yeah.
Yeah, and it can be. I'm not unsympathetic to that point because it is a slow process. We're also working with a number of estates right now, clients who've passed away, and going through the probate process, especially as we're talking about multi-million-dollar estates, complicated estates, can take 2 to 3 years to administer, whereas that beneficiary designated account instantly transfers to the beneficiary. So, avoiding probate provides expedience, but things subject to probate are, you could really say carved into concrete. That's a process that is monitored by a court. Everything, all the I's are dotted and T's are crossed to make sure all the assets have flown where they need to, that the taxes have been paid, outstanding liabilities are handled. Makes a lot of sense. And frankly, for situations where there could be a lot of family fighting or questions about where the ultimate disposition of the will or assets ought to be made to, probate can provide a venue for all of those complaints to be heard and then handled in an equitable fashion.
I'm thinking of an example. We had a client passed away a year ago, 2 years ago. We were working with their attorney, and they have 3 children, named IRA beneficiary. Most of their assets were IRAs. She was the surviving widow, so her husband had passed away. IRA was most of the estate. She named the 3 girls as primary, and then she had an investment account and named a transfer on death. Beneficiary designation also to the children. So there was nothing left in the estate, and that was going to create some problems that there's no money to pay the bills. Like, it's given to the kids and they could take it then. So you don't want everything to go. You have to preserve some liquidity, I think what you're saying.
Yeah, absolutely. So great example. So like we said, probate can be a multi-year process, and involved in that process are your financial advisors, your estate attorney, who's most often the person that helped you draft the will and the trust if there is one. Accountants get involved too to make sure the taxes are paid on an ongoing basis. So it can be expensive too. Just the fees that you have to pay, let alone the opportunity cost, I guess is another way to look at it, of how much time that takes to go through it. So that said, this is a really good reminder back to the top of do this planning with an attorney, with your accountant, with your financial advisor, to tease out, okay, most of my wealth, as the example you gave, that client had most of their wealth, their liquid wealth, tied into investments with us that all left the estate via beneficiary designations, leaving nothing in the probate estate, not as much liquid assets in the probate estate. Putting some meat on the skeleton, that means like the house, the family house, for example, could be left in the probate estate. Let's say there's an outstanding mortgage on the family house in the probate estate. And further, let's say that the house was to be given to one of the 3 kids free and clear. Well, if there's no money in the estate to pay the attorney's fees, accountants, financial advisors, property tax, and satisfy the mortgage, something's got to give.
Right.
And in that example, it would most likely be, sorry, kids, we got to sell the house here to generate cash to get us through this. Or as a different alternative, and this would be something that all the kids would have to get on board with and you'd have to talk to the attorney with, contribute money into the estate to settle its financial affairs so that the house can be, or you're essentially buying the house out of the estate early. So that type of planning to make sure that there's enough liquidity in your estate is very important. So that is to say, to put a nice bow on this topic, you don't want to go hog wild with your beneficiary designations, because there may actually be an argument that we need liquid assets in the estate. Unfortunately, that means the payout's going to be delayed, but you need money to handle this affair. So,
right. Can you talk a little bit about the distinction between, let's use Pennsylvania inheritance tax, which most states have some form of inheritance tax, and federal estate tax?
Yeah.
Most people don't know the difference or what those mean.
Yeah, I'm going to stop you right there, though, too, actually. Pennsylvania is actually one of only 5 states that has an inheritance tax. But it's still important to tease the difference out. So let's go back to the example. You die, everything goes into your estate. And just to really put a neat bow on this, too, even if you have beneficiary designations on accounts, your IRA, your 401k, even though those accounts avoid probate, they're still part of your total estate. When you die then, in Pennsylvania, transfers made from an estate to beneficiaries are taxed at varying rates. So, for example here, again, picking on Pennsylvania because that's what I'm most familiar with, if an estate is making a gift benefiting a spouse or a minor child of the decedent, there's no Pennsylvania inheritance tax.
Okay.
There's a 4.5% inheritance tax levied on transfers to what they call direct descendants, which would be children or grandchildren of the decedent, 12% on transfers to siblings of the decedent, and then a catch-all final 15% tax on all the rest, anything that doesn't fall in that category. Obviously, there's no inheritance tax levied on charitable donations, but that matches the federal system. So if you die in Pennsylvania, and let's just say your estate is $100,000 of cash, and it's all going to Mrs. Bishop here. Mrs. Bishop would receive that $100,000 free of any tax levied on it because she's your spouse.
All right.
Let's imagine you wanted to benefit one of your friends at your death and give all that $100,000 instead of my mother going that to one of your buddies or something. That would be taxed at 15%. And typically the estate is responsible for paying that tax.
Okay.
That's all state tax in Pennsylvania too. Like, for example, Florida does not have any sort of estate tax. So these rates that I've just mentioned don't come into play in 45 of the other states. The federal estate tax is different, is levied completely independently from whatever the states are doing or not doing. And it's related to gift taxing as well, something else that a lot of clients talk about. So first, coming at it from the estate angle. If an estate has less than $15 million, is worth less than $15 million, again, that's the house, houses, investments, cars, this, that, and the other thing. $15 million, if an estate is smaller than $15 million, there's no federal estate tax levied on it. If it's over $15 million, transfers beyond that are taxed at 40%. So it's pretty steep.
Yeah.
And this is the point where we would definitely recommend, if you are in a state or you're in a situation where you're likely to have more than $15 million, all in, this is everything, all in, you should absolutely be talking to an estate planning attorney to figure out how can we minimize the tax burden at the end of the day. So you have that $15 million that you can give out, essentially transfer out of your estate to beneficiaries without being taxed. Anything beyond that's at 40%. That same $15 million, consider that sort of like a bucket full of water. So you can drink all that water at your death, give out $15 million worth, exhaust it, pay no tax. If you go beyond that, you got to pay tax on that. That $15 million is also what's referred to as your lifetime gift tax exemption. It's the same number. It's the same bucket. And what that means is any taxable gifts that you make during your lifetime eat into that $15 million, so that when you ultimately die, you have less of that $15 million available before you get taxed at 40%. I'm working backwards in on the way.
This is great.
But what is a taxable gift? Because not every gift you make is a taxable gift. So a taxable gift is any gift of anything, cash, assets, whatever. If forgiveness of debt too is also can be considered a gift. But anything along those lines in 2026 greater than $19,000. You might have heard the annual gift tax exclusion amount. That's what this is. So essentially the government has said, okay, in 2026, one giftor can give to a recipient $19,000 this year, and don't worry about it. You don't got to tell us about it. Don't file a gift tax return. You don't owe us anything on it. And that's also not income in the hand of the recipient. They don't get income taxed on that gift.
Almost no one knows that.
Yeah,
I think 3 times this week we had clients asking, I want to gift to grandchild or child. They pay income tax on that, right? Everyone thinks that that's income to the recipient.
Yeah, that is, the gift is not income
even
to the
if it's $1
recipient.
million.
Correct. Yeah. So even if you are making a taxable gift to that beneficiary, you as the giftor are paying that tax. And I'd be remiss if I didn't say, like in my CFP studies, that there's another sort of formula you can figure out where the recipient pays it. It's called net gifting, but that's not worth getting into here.
Let's get it.
At a high level, the giftor is the one paying tax if there is tax to be owed.
Okay.
So let's we went backwards into it. Let's walk forward back through it. So let's say that you give me, I'm asking you, can you give me $19,000 in 2026? So if you, Michael William Bishop, stroke a check for $19,000 to me, Michael Bishop, you will not have to pay any tax on that.
Right.
That will not count against your lifetime gift tax exclusion, and that's not income to me.
Perfect.
Let's say you, instead of 19, you're like, oh, Mike's been good this year. I'm going to give him 20 instead. You have made a taxable gift of $1,000 because that's $1,000 over the annual gift tax exclusion. That $1,000 you don't pay any tax on, but now you do file a gift tax return telling the IRS, I've used $1,000 out of that $15 million bucket that I have available for me at the end of my life. And so on and so forth. So if you make a larger gift, there'd be more to report. And then related to this too, be worth mentioning split gifting. So then we said one gifter can make a gift to a recipient of $19,000. Married couples are allowed to do what's called split gifting, where they each can consume their annual gift tax exclusion amount to benefit the same beneficiary. So if you and mom wanted to say, oh, Mike's been real good this year, let's not give him 19 or 20. Let's give him 19 times 2, 38,000 this year, because that's under both of our annual gift tax exclusions. We don't eat into the 15 million, but because you've done split gifting, you still do have to file the tax form with the IRS to let them know that you've done that. So,
okay. And if there's a young Mrs. Bishop and Mr. Bishop Sr. could also gift to her.
Yeah, right. But that's complete fantasy. So
so another 38
right.
from the same 2 giftors would not violate that $19,000 per person because you're spreading it to another recipient.
Correct.
Okay.
So yeah, in a world where a married couple wants to benefit their child who is married and everyone likes each other and they all get along and we won't talk about any prenup issues or anything like that, you could give from parent to child effectively, what is that?
38 and 38, 72.
$72,000 in a year without paying any tax, but needing to file the gift tax return.
76.
76. Yeah, I can't do mental math either.
Wow. Okay. That was such a good explanation. There's so much confusion over that, how that works.
Yep. Yeah, we get asked that all the time.
Yes.
I think, And I think this is a I think this is a good thing. Clients then ask us, what is our opinion of gifting? Should we gift? Or what are your other clients doing? Working backwards, doesn't matter what other clients are doing. You need to do what works best for your situation and your estate. So it doesn't matter if your neighbor's gifting money to his kids. What are you thinking, and what is your relationship with your kid like?
So this reminds me of an older gentleman client we have. He's good friends, not a client of ours, of another couple who do pretty substantial gifting to their children. And every year he asks me, I think we should be gifting. I think I should be gifting to my kids. And I remind him all of his wealth, except for just a small amount in like a checking account, all of his wealth is in an IRA. Yeah. And I try to explain to him, to do the gifting, you've got to take it out, pay income tax.
Yep.
That's heir one. We don't want to do that. Then you're gifting to your kids. Versus when he dies, this is something we're going to get into in a minute, they would inherit his IRA and can stretch the tax. But gifting out of an IRA makes no sense. Yeah. Because you've got to create a taxable event to get it out of the IRA, then do the gifting. And I think a lot of people are into that misnomer that they're missing something.
Yeah. And I think that's ultimately what everything we talk about here today comes down to, is a little bit of FOMO, to be honest with you. People always think that there's more that they could be doing, but sometimes simplicity is better. Even if you have a multi-million-dollar estate, you may not need all of the life preservers and, guide lights and just to make an analogy out of it. You may not need all the bells and whistles of a very complicated estate plan. It is very customized. There's no such thing as a one-size-fits-all estate plan. I do want to talk about, that's another highly complicated area of questions that we get from clients about inheriting an IRA. And there's been a ton of changes to that in the last 6 years alone, with the Secure Act 2.0, changing how the RMD rules work for beneficiaries. That's very integral. And again, another thing that you could talk to your estate planning attorney, accountant, and financial advisor to figure out, is the table set in a way that works best for me, that I like, I'm comfortable with, and works from a tax perspective too. Really at a high level, if you have an IRA, Roth or traditional IRA, the rules are in this way the same, and you have, let's just say it's a young married couple who each have IRAs. Neither of them have started taking RMDs, and let's say husband dies before age 59 and a half, which is the earliest he could start taking from it, even though
without a penalty.
Without a penalty, yep. So effectively, think about it like the can has not been cracked yet.
Okay.
Money was going in. Unfortunately, husband died at a young age before any money had started to come out or was required to come out. And let's say his primary beneficiary was his wife. In that example, wife is allowed to roll his IRA into hers. And again, think about this sort of just at a high level, like a tax law philosophy level. With all these accounts, IRAs, 401ks especially is what we're picking on here. But the benefit of those accounts, those tax advantaged accounts, is the IRS is making a deal with you. Is they're saying, look, for like a traditional IRA, we'll give you a little tax deduction for contributing towards your retirement. We want you to do that, so we're going to reward that and give you a tax deduction for doing it. But we do want our money. We want our money eventually, and we're going to get it at least as soon as when you turn 73, when your RMDs come out. If you look at, and no one does, I do because I think this is interesting, but if you look at the commentary, like the congressional commentary that was surrounding the Secure Acts, part of the Secure Act, both of them, their passage was they are revenue generation bills for Congress because they knew they'd be getting tax revenue from people taking RMDs. So that's another lens to look at this with, to not get too bogged down in all the minutiae
So just
rules.
another way I've explained it to clients before, if I have a pile of money, let's say I have $2 million, $1 million in an investment account, $1 million in an IRA. Those are not the same thing. I think what you're saying is
Yep.
the $1 million in the investment account is already been taxed.
Yep.
Yes, there will be capital gains tax on any future growth, but that's post-tax money. That's
Yep.
mine. The IRA, let's use a 25% tax bracket. 75% of that is me. 25% is the IRS's money. I just haven't paid them yet.
Yeah.
So it's just they're allowing you to stretch out when you take it, but they're going to get their 25%.
Yep. Yeah,
Okay.
exactly. The most common example that we see of this type of distribution is child inheriting a parent's
Right.
IRA or 401k. In that example, and let's keep the facts this, or actually, it doesn't matter whether or not
Right.
parent has started taking the RMD
Correct.
or not. If you are a child, and there's some exceptions around this too, limited for minor children or certain people with disabilities, but if you are a child receiving as an inheritance your parent's IRA, you are what is called a designated beneficiary, and the same sort of thing applies to you. You have to keep those RMDs going if they were going, but either way, the account again has to be drained by the end of the 10th year after death. So, again, which taking those distributions as a beneficiary, that's ordinary income
Yeah.
to you.
At your rate.
at
So if you're
your
still
rate.
working, you just throw that on top at whatever that marginal tax rate is.
Yeah, so it can be
Yeah.
receiving an IRA as a beneficiary is not completely sunshine and rainbow. That is adding to your tax burden in effectively the most expensive way.
Yeah.
So it is something, obviously, I don't want to discount that as an effective estate planning tool because, again, wrapping back to the top here, the convenience and ease of being able to transfer an asset with just a beneficiary designation like an IRA or 401k. The pros of getting that out of the estate handled and into the hands of the beneficiary outweigh perhaps the elevated tax burden that beneficiary is ultimately going to bear. Again, a great conversation to have with your estate planning attorney.
Right. One other quick point, which I learned this probably in the last year, Roth IRAs.
Mm-hmm.
So there was no tax incentive going in. You didn't get a deduction when you made a contribution. Yep. But once it's in the Roth umbrella, it's tax-free forever. No gains, no income, no distributions are ever taxed. They're very valuable.
Yep.
But those still require the 10-year distribution rule upon inheriting one.
Yep.
And it's like, well, what's the point of that? It's not taxable. But once you get it out of the Roth and it's in a regular account, then that income is subject to income tax and capital gains. So again, it's revenue generation for the government.
Right. Yeah. It's not for us.
They want that Roth depleted.
Exactly. Yeah. They'll give you the benefit at the front end, and then we have a very clear defined age of 73 that, well, the jig is up, guys.
Yeah.
You got to start paying us.
Because I think prior to Secure Act, someone could die with the Roth, leave it to their kids. They could leave it to their grandkids. It could just keep on going forever.
Yeah.
That's not the case anymore.
Yeah. Oh, yeah. No, not the case anymore. Because they wanted to Congress wanted to make money and close the deficit up.
Shocking. Okay. Beneficiary designations. You talked about TODs, probate versus non-probate a little bit.
Yep.
Inheritance tax.
Yep. Something I think to keep in mind with this too is it's also not uncommon to see a client in retirement who's worked at multiple employers over the course of their career. They had a 401k here and they rolled that into a Roth and they added this, that, and the other thing to the Roth, and then they got another 401k from this employer. And as a result, now they're an 80-year-old person with like 4 different 401ks or 4 different IRAs. Maybe like some of them are at Fidelity. This one's with Equitable Advisors. Wherever they may be, a scattering of $100,000 here, $120,000 here. Don't know how to change the beneficiary designations on this one. I haven't talked to this investment advisor in 15 years. Part of good estate planning, I think, is consolidating that. And it's probably the most laborious part of estate planning, if I'm being honest with you, because it involves you having to figure out, okay, I haven't talked to this guy at Fidelity in 15 years, so I got to see if he's even still there. Is the office opened? But you should consolidate, and we've alluded to this before, you should consolidate your investment assets to the greatest extent possible. Yep. And what I mean by that is you should have, as a result, like that person who has 4 different IRAs, you should have one IRA. You can roll IRAs into other IRAs because they're yours. It's like as long as they're all your IRAs, you can consolidate that. And like we talked about in one of our early episodes too, one Eisenhower on D-Day, you should consolidate those entire retirement assets under the management of your current, presumably only, investment advisor.
So the one Eisenhower and D-Day, one set of strategy,
Yep.
fee consolidation, it's
Yeah.
going to save on fees, diversification, it's going to avoid duplication of 2 different mantras of what do we do in a bear market. It's, from an investment standpoint, clearly the best thing to do. Here's a even more imperative reason for your beneficiaries of you leave them with a mess.
Yes.
And when you're done, I've got a perfect example of that. But
yeah, it is a mess. I don't want to beat this dead horse too much beyond death, but as we talked about in the last time we had been on this topic, a lot of people are under the misapprehension of, I've got 4 advisors, so maybe one of them will outperform the other. It's like, do you have 4 accountants doing your taxes every year? And it's like, that is complete
you have
nonsense.
4 surgeons looking over your aorta.
Doing the same thing?
Yeah, right.
It's nonsense. But think about it literally logistically. When we have a client who dies, and let's say he has an IRA and a Roth IRA and maybe just a traditional investment account, 3 individual accounts in his name. The estate, to prepare the estate tax return, if it's like, assume a Pennsylvania estate, they're going to need date of death valuations. So in the instance where you've consolidated that all under one advisor, that's one call to the custodian from the advisor, that's one email back and forth, and then that's presumably one person or one team that you have to interface with if there's any ongoing issues or distribution things that you have to talk with. Not putting your kids presumably in the position of, oh man, dad had an IRA at Fidelity and maybe he had one at the bank and I don't even know where that bank is. Or they got bought out by this bank after the recession.
Did he take his RMD last year?
Did he take it? It is a nightmare slew of
We're
issues.
dealing with that right now. A client of ours, single client, inherited 6 accounts from her sister who died 2 years ago, all with different custodians. So we were piecing together for the sister all of the RMDs, when they happen, cost basis, date of death valuation. And then our client passed away, and there's still other assets coming out of the woodwork that weren't known about. So now there's 2 estates going on. It is, oh my gosh, it's such a paper nightmare for the beneficiary. The attorney, we're helping them piece together this puzzle. It just creates so much unnecessary work.
Unnecessary work, cost, delay. Not to put too fine a point on this, but good estate planning is picking one Eisenhower on D-Day, one financial advisor, one tax advisor, one attorney to orchestrate your ultimate disposition. Otherwise, if you don't do that, someone's going to have to do that. And I can't imagine you would want your children to do that. Quite honestly.
I might.
Thanks, man. I appreciate it.
Yeah, that's great. I think that's excellent knowledge for people to have clear up some of the mystery and have some path to go forward with their attorney. And again, it's that procrastination. It will catch up and it'll be much more costly and confusing when you're not here to get that clarified.
100%. Thank you for tuning in to the 5th episode of The Fiduciary's Edge and the first one on video. Our main takeaways from this episode are that everyone should have a will, but certainly as your estate grows in value over your working life, your estate will also become more complex. And so things like consolidating your accounts, perhaps considering a trust, or any other tax and investment planning strategies that need to be employed, you should certainly talk with your tax advisor, your legal advisor, and of course your financial advisors. Thanks again for tuning into The Fiduciary's Edge. We're on a mission to teach people how to avoid herd mentality by focusing on the decades rather than days. If you want to learn more, watch out for our quarterly newsletter and podcast. And as always, all views and opinions expressed in this podcast should not constitute financial or legal advice. Past performance is no guarantee of future results.